Hey, what's up, everybody? It is Tuesday, April 12th. Market's down today. They gave up some gains early in the day and then they just kind of deteriorated, but they were off their worst levels, but not by much. So today we saw March CPI, and actually, if you look at the core CPI in that report, which excludes food and energy, that was up 0.3%. The big increase in inflation has been in energy, and we got to keep an eye on that. We have seen actually crude bounced up today again, back over $100, but we've been wavering around in this area. And I mentioned yesterday that gasoline prices at the pump have been down for 2 straight weeks. Not sure if that's going to continue. I will say, or I will repeat, that oil producers are still net long futures contracts. That's that's an unusual position for them, because in general they are short the futures markets because they use the markets to lock in profits and to hedge. When they are net long the commodity that they produce, that's telling you something right there. I've seen some selling by producers in the last 2 weeks. However, they still have a very sizable net long position. I would not be comfortable calling a reversal in the oil trend until I see producers flip to net short. And so far there hasn't been any indication of that. Here's a question I want to ask everybody. What is meant by liquidity? Hear that term thrown around a lot in the financial markets and in commentary. Analysts talk about liquidity, and usually it's in reference to what the central bank or the Fed is doing. And Mike Wilson, who is an analyst, strategist, I don't know what his official title is, at Morgan Stanley, he's really bearish on the market. He said last week that was it for it was a bear market rally and you had to go short, and he called it right. I mean, it has turned around. We've given back about half of the March rally from the low point in March. I think that was March 4th up until March 29th, maybe even gave back a little bit more than half. So good call by Mike. But Mike is saying that the Fed is going to be one of the main reasons he's bearish is because he's saying, hey, they're taking out the liquidity. Taking out the liquidity. What is liquidity? That's my question I want to ask everybody, because for me, I don't think I have the same definition as everybody else. Usually, when you hear Wall Streeters talk about liquidity, or when you hear economists talking about liquidity, they're talking about reserve balances. Printing money, like when the Fed, and it's always in relation to, or it's always tied to monetary operations like QE or something like that, quantitative easing, which again is not an easing. Quantitative tightening is not a tightening. It's a recomposition of assets, blah, blah, blah. I've been over that a million times. But when they talk about tightening liquidity, they're referring to the Fed reducing its balance sheet and, as a consequence, reducing the level of reserve assets in the banking system. Now, when I think about liquidity, because, to me, reserve assets, they're kind of useless. Anything above, the required reserves. In other words, excess reserves. They just sit there in the banking system on the bank balance sheets, all right? And they hardly earn any money. I mean, up until now, what was the Fed paying? Like 25 basis points? Now it's 25 to 50. I mean, come on. So reserves is this so-called liquidity that these people are referring to. Basically, they're referring to reserve assets which sit in the banking system and serve no function. I mean, they're not lent out, okay? Like I said in one of my past videos, they couldn't even lend them out. I mean, the only way they're kind of lent out is overnight among banks. Like a bank could lend its excess, some of its excess reserves to another bank if they're short on reserves. Like if they're not hitting their, if they don't have their reserve requirement, they can lend them out to each other overnight. But it's not the kind of lending in the sense like loans. Loans create new reserves. Like the banks can't really even lend them out even if they wanted to, because it goes nowhere. It just stays in the banking system, sitting there on the balance sheet of the banks. It just changes ownership from one bank to another. Does nothing. So I mean, and then again, it's not earning hardly anything. When I think of liquidity, I think of three things. I think of strong fiscal. That's liquidity. I mean, we saw that very, very clearly in the pandemic with all the stimulus when, personal saving went up to $6 trillion because of the massive, massive stimulus, the checks that the government was sending out, the unemployment insurance. That's liquidity, man. That's real liquidity. And even though that's come down, I mean, it's still very solid. I mean, we're looking at a 580 billion month for the month of April. We had a 633 billion month in March. We had a 610 billion month in February. So number one, I look at fiscal. That's liquidity, man. That's putting real money into people's pockets. And it's not just reserve assets sitting there like dormant in the banking system, clogging up bank balance sheets with low yielding assets. All right. So that's number one, fiscal. And we have that. We have that going. Okay. It's not the same as, last year, but it's not that bad. Remember, I told you to see 633 billion a month, you got to go all the way back to July of last year. And that was not bad. We were not in a bad situation economically. We were not in a bad situation with regard to the market if you go back to July 2021. So number one, that's liquidity. That's the fiscal. Number two, bank loans. Okay, bank loans provide the financing for, firms, for expansion, for investment, for payroll, for all of these things. Bank loans. And again, when you have trillions and trillions of dollars in reserve assets sitting on bank books, that just constrains the ability of the banks to lend. They either need more capital. All right, you're dumping trillions of reserve assets for all the new assets. You need a certain amount of capital, right? You got that leverage ratio, the supplemental leverage ratio, that's got to be 3% or greater. So every time when the Fed dumps all these trillions and trillions of reserve assets on bank balance sheets, it impedes lending. It holds it back. So that's number two. So number one for me, this is for me, you might agree with me, you might not agree with me. Number one, I believe the number one source of liquidity is fiscal. That's the government handing out money to people. Whether you like that or not, that is pure, unadulterated, high-powered liquidity. You get a check, you could spend it. There's no offsetting liability that comes with that. That's high-powered money. Number two is bank lending. When the banks are extending credit and everybody has access to credit, or most everybody has access to credit, that's liquidity. And that could go for, depending on the burden of debt service. I talk about that, like what is the debt service burden? Okay, how tough is it to service your debt? Right now it's very, very low. Historically, it's like 9% of disposable income. In 2007, it was like almost 14%. That was when, the whole great financial crash happened. And that, by the way, that never should have happened anyway if it was a proper response to begin with. But the Fed dragged its feet. They didn't know what to do. It took time. So that's number two on my book. What is liquidity? Definition of liquidity. Right? And there's a third, if I can remember where I was talking about this earlier today. So you have fiscal. Oh yeah. The third is when there is an income transfer to the economy. Now, that's kind of like number one. When the government sends out checks to people, that's a net transfer from the government to the non-government to the economy. But number three, my third example of liquidity is when the economy is holding assets that earn a higher income, a higher rate of interest. And so like when the Fed shrinks its balance sheet and when it reduces those reserve balances, you're going to have banks, you're going to have the economy, that could be firms, individuals, holding more of those treasury assets that formerly the Fed was holding. It was taking that money for itself. Now those income flows are going to be going into the economy. You got it? So those are my three pillars of liquidity. It's not trillions upon trillions of reserve assets just sitting there dormant, clogging up the banking system, going nowhere, making some puny 25 basis points or 50 basis points, whatever it is. No, it's fiscal, which we still have. All right? It's bank lending, which, by the way, when the Fed reduces those reserve assets, like I just mentioned, what happens? It clears up room. It makes space on the bank's books, on their balance sheet, to add other kinds of assets, namely loans. You're going to see, and I'm going to come back to this many, many times in videos over the next several months or over the course of this year. You're going to hear me talk about, hey, look, reserve balances are way down, and guess what? Lending is way up. People think it's the opposite. I mean, even central bankers, their mentality is like, oh, we got to pump up the reserves so the banks can lend them out. It's just wrong, man. It's wrong. So when the reserve assets come down, you're going to get my second point of liquidity, which is now the banks are going to be able to lend more. And finally, with the Fed not buying securities and keeping that money for itself and then giving it to the Treasury, I mean, that's just like taking that income into a black hole. It's not going anywhere. Now it's going to be going into the economy. So you're boosting the income to the economy. That's liquidity. So again, this guy's talking about the Fed is going to be draining liquidity. No, that's not. All they're going to be doing is reducing the reserve assets in the banking system. And what's wrong with that? I just explained to you how that is like a beneficial thing. You don't need, listen, there was even a couple of years ago, and I was talking about this, there was a poll taken by the Fed. The Fed sent around a survey. It was a survey that the Fed itself sent around to all the banks, asking the banks, what is your optimal level of reserves for the system, meaning the banking system? You know what they said in that survey? 600 billion would be the optimal level of reserves. You know what the reserves are right now? They're 4 trillion. 4 trillion. So that was the banks themselves responding to a Fed survey, the Fed literally asking them, what level should the reserve balances be in the system? And they said 600 billion. Okay, we'll pump it up then to 4 trillion. You don't need that. The only thing you need right now, actually, because deposits are 18 trillion, if there's still a reserve requirement, I'm not sure, they might have suspended that, but it's usually 10%. So you need 1.8 trillion if you're going to go according to Fed regulatory mandates. 1.8 trillion is 10% of 18 trillion of deposits. So, we're like way freaking, we're 2.2 trillion above that level. So like the Fed could literally take reserves down by 2.2 trillion and the banks would be, in compliance. Oh yeah, you'd have a lot of people like this Mike Wilson guy freaking out saying, oh, the liquidity drain. But it wouldn't be, and you'd see lending really go, man. Lending, listen, there's only two constraints on lending. It has nothing to do with reserves. That's number one, it has to do with bank capital. All right, banks are well capitalized right now. And number two, it has to do with the credit worthiness of the borrower. And that is looking very healthy right now. And it's going to get healthier if when the Fed stops buying securities. Again, that's an income transfer into the economy, an income transfer into the economy. I would only be worried about the lending situation if we saw debt service burdens go back up to that 13% or 14% high level, but we're still a long way from that. So that's my definition of liquidity, folks. What is yours? Have a good one. See you tomorrow. Bye.